Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. FY26 has brought with it several tax changes. Yes, this is the new financial year, and the biggest of these tax changes is the huge sweetener in the new income tax regime that has been offered this year. Now, this, along with major capital gains tax changes that were announced in the July budget in July 2024, mean that you need to look at your financial planning with perhaps a new sharp tax lens. To help us do this, we have with us today Mayur Shah of EY India and Mohit of Moneyfront. Gentlemen, thank you so much for joining in. Great to have both of you on. So I thought it's a good idea to, get the house rules out on the table so we know. Of course, tax, all experts will tell us. I'm sure, Mohit, you'll agree, right? Tax is not the only reason we decide where to invest and how to invest. But it's a very important part. We can't ignore it either. So welcome to the show. Mayur, first thoughts.
Thank you. Thank you so much for this. And yes, you are right. Absolutely right. When we are really looking at it, we should look at net return which a person gets, return on investment. And especially when you are looking at, say, something which is getting taxed at regular rate, something which is getting at a concessional rate tax, then, the difference, the value, our money in the pocket is much larger than what we expect. So therefore, I think tax will also play an important role.
Absolutely. Mohit, smart tax planning. And this year, the finance minister has told us that if you're in the new tax regime, you can save up to 1 lakh rupees. So what do you think? Is this 1 lakh going in investments? Where should it go? Or should it go in spending?
Thank you very much, Surbhi. Look, I think I'm a firm believer that all that you earn should not be put to savings. Some things should be actually spent in a wise manner, spent for your personal necessities, spent for your experiences in life. So, of course, by all means, save much more than what you were saving previously. But yes, I think some portion has to be spent also, and that has a different kicker and a different multiplier for economy.
Oh, absolutely. All right, so get your paper and pens out, or your tablets or your digital devices out, and take notes, because this is Tax Planning 101. Mayur, my first question to you is going to be, we need to understand and illustrate what this means. Because one thing we know is now that if you have income of up to 12 lakh rupees, you don't have to pay income tax thanks to the rebate in the new regime, right? And also what the finance minister said, that you end up saving 1 lakh rupees. So just do the math for us, help us understand. How do we arrive at this? What is happening in the new regime?
Yeah, so what happens is that when income is up to 12 lakhs, probably you will calculate tax, but then you will claim rebate as a benefit. And therefore, effectively, you will land up paying no tax on that income. Okay. And that's where, you will be saving up to 1.5 lakh just because, your income is above approximately 12 lakhs.
So the rebate is 60,000 in the new regime now. And that's why you don't have any tax liability.
So this is rebate from income itself. So if your income is up to 12 lakhs, 7 lakhs is what you get additional rebate. And as a result, your income tax really goes to zero.
Okay. So that's how it is. And what about this 1 lakh rupee saving? I mean, is it for all taxpayers? Anybody with income above 12 lakhs? But how do we arrive at this number?
Correct. So what happens is that what has happened, that if you look at slabs, which was earlier, which was moving up to every 3 lakhs. And now it has changed to 4 lakhs. Earlier it was ending, so maximum marginal rate came at 15 lakhs. But now it is coming at 24 lakhs. Right. As a result, the slab benefit has increased a lot and new rates has been added. Sure. As a result, you will be able to save around 1,43,000. And this applies across the board. It does not mean that it is only for the low income or high income or middle income. It is for everyone.
Everybody ends up saving a minimum of 1 lakh rupees.
Absolutely, because of the slab change.
Because of the slab changes. Got that point. So we'll come down to the math in just a minute. But Mohit, I remember when the budget was announced, I remember doing conversations and shows on this. So the rough rule of thumb that was coming out was that if your total deductions are very high, I think if they're higher than, say, 8 lakhs or 9 lakhs, maybe you're still better in the old regime. But, what did the numbers throw up for you?
Yeah, I think, Surbhi, there are certain calculators which are floating across all the social media handles, and I'll just give you a rough texture and flavor of this. So my sense is, if you earn up to 12 lakhs, then you are better off always better off in the new regime. If you earn anywhere upwards of 13 odd lakhs, and then the number changes every lakh onwards. If you're earning upwards of 13 odd lakhs, and if you are claiming deductions of around 4.44 lakhs or anything higher than 4.4 lakhs, then you might perhaps still want to be in the old regime. But if you don't have deductions totaling up to 4.5 lakhs, then you might want to take a switch to the new regime, and new regime will actually work better for you. The moment you go upwards on the salary band, which is from 13, you move to 14, 15, so on and so forth. This band of deductions, which is for 4.44 or something, will keep moving up a little. It will go up to, let's say, around 5 lakhs, 25 or 1,000 if you're earning 20 odd lakhs.
Okay. I think we
So yes, a short answer to your question is be in the new regime if you can't claim deductions more than 4.5 lakhs.
got that point, and which is why, viewers, please note that whatever deductions you are claiming, that becomes the single biggest reason that will determine whether the old regime is better for you or the new regime is better for you. Mayur, now let's take this with an example. I want to take an example. We've got some numbers on the screen as well. Let's assume someone has 30 lakhs of income.
Correct.
Now let's take different scenarios with low deduction, medium deduction, very high deductions. How does the comparison change between old and new?
Sure. So as rightly pointed out by Mohit, what happens? It's a combination of level of income and level of deductions which you intend to claim. Basis which whether new regime is better or old regime. Let's take an example, as you rightly said, let's take an example of 30 lakhs. And if my deduction is 2.5 lakh, the total tax liability which needs to be paid under old regime is around 6 lakh 63. But if we look at new regime, then it will come to 475, whereby you are saving around 1,87,000.
So if your deductions are as low, we have the numbers on the screen. If your deductions, you can see the table there. If your deductions are as low as just 2.5 lakhs on an income of 30 lakhs, then you are definitely better off in the new tax regime. Now let's move on. Let's talk about someone who has higher deductions than 2.5 lakhs.
Let's say that 30 lakhs is the income and the deduction is around 8.5 lakh. Then I think it will be neutral whether you follow old regime or new regime.
Okay.
Then the dependence are there any other additional advantage which you are able to claim if you are going in the old regime? The advantage is that, if you have any carry forward losses, then you will be able to carry forward if you are following old regime. Then your dependency will be based on what other additional thing which otherwise I would have lost if I would have gone with the new regime. So those aspect needs to be considered to arrive at whether I should go with the old regime or new regime.
Okay, so this is really important. Now what you see on the screen is extremely clear that if, again, 30 lakh rupees is the income level we have assumed, if the deductions are as much as 8.5 lakh rupees, then both the regimes are the same, old and new. But old may still be better because you can claim certain set off of losses, etc., certain other deductions. Got that point. So is there any scenario in which the old regime is still beneficial versus the new regime?
Correct. See, old regime would be beneficial where deduction is below 8.5 or, when it is 8.5. So if 8.5 is a break-even deduction, in that situation, if you have, say, house property losses which you need to carry it forward, then all this will be beneficial to follow old regime. But otherwise, new regime is much better.
Now let's talk about someone who has even higher deductions, 10 lakhs as deductions.
Correct. Then the old regime becomes very easy.
Okay.
So I think I would like to correct what I have said in past, that when the deduction is lower, new regime is better, but when deduction is higher, the old regime is much better in those situations.
Got that. So that's the thumb rule. Higher your deductions, maybe there are chances that the old regime is still suitable for you. But if you have very low deductions and exemptions that you're claiming, then just move to the new regime, which then brings me to the point we need to quickly recap what are these deductions. How does someone claim as much as 10 lakhs or 8 lakhs as deductions if you count all the chapters?
Correct. So, the deductions are multiple. I mean, for salaried employee, the biggest one is house rent allowance. So when a person is paying rent, HRA seems to be exempted. That is the biggest one. Then, we look at, leave travel assistance which is being provided, which can be claimed as an exempt. Along with that, especially technology persons, when they travel, they don't get a reimbursement of the expenditure incurred. But what they get is per diem allowance. And if they follow new regime, then exemption of per diem allowance is not applicable.
Okay.
And therefore, they tend to lose a lot of value there.
Okay.
So you need to consider even that as well.
Okay.
Apart from them, income from, losses from house property.
Like you explained, yeah.
Yeah. So that's another one which you are likely to lose. So if I'm not a salaried employee and if I'm having a business, then I may tend to lose depreciations or carry forward of depreciations.
Okay.
And so likewise, I don't get deductions under Chapter 6A as well.
Sure.
Which is, insurance premium or PF contribution or PPF contribution.
The lovely 80C, which is 1.5 lakhs of, deductions that we get there.
Absolutely.
Okay.
Apart from that, what you also don't get is that premium paid for medical insurance.
Yeah, 80D, Section 80D. So you don't get that in the new regime.
And any donations, charitable, or any philanthropic activity which you have done, you don't get deductions for that either.
Sure. So, well, that's the rule of thumb. Keep this in mind. Look at all the deductions you can claim very, very carefully. Total all of them up. And HRA would be a big component of that if you're living on rent. And then do the math and decide whether the old may still be better in some cases. All right, we have to take a very quick break on that note. We'll come back on the other side. Now that we've understood the income tax part of it, the question is, what about investments this year? How have tax rules changed? Where should we invest? What is tax effective and what is not? Back with that in just a bit.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are talking taxes. It is the new financial year. April has just gotten over, and we need to understand if we've chosen the right income tax regime and if we're planning our investments in a tax-efficient manner. Mohit, I'm going to come to you on this one. Now, pure equity is fine. I mean, we were all living with it, dealing with it. That long-term capital gains is not 10%. It's 12.5%. My question to you really is that, and this is a year where equity markets have been very volatile, right? So people will look beyond equities to diversify their portfolios. So when we get to the hybrid fund category or things like maybe REITs or InvITs, things to diversify, which of these options looks a bit tax efficient to you?
Absolutely. I think, Surbhi, this budget actually has ushered a lot of good news for investors in multiple categories of mutual funds. So if I were to just point out a few categories which have really benefited, I think the number one category and which is shining the brightest is gold, silver, the commodities category. Previously, the taxation out there was not as favorable. It was long-term was defined as 3 years. Now the long-term has been redefined as 2 years. And the long-term capital gains is 12.5%. Obviously, there is no indexation any further, but 12.5% after 2 years is a pretty good and a pretty neat deal for anyone who is willing to invest in commodities. So that's, to my mind, the biggest advantage. The second biggest category is the international funds category. There's a lot of interest, a lot of money which has been off late going into US funds, other, let's say, global funds, global themes. So those were all taxed like your debt funds previously. But now again, on those international fund of funds and international funds, the taxation is very clear. Long term has been defined as 2 years and the taxation is 12.5% out there. And similarly, fund of funds category is also something which is benefited and the taxation is same as gold and international funds on that.
So let me ask you this, that's the tax part of it, right? That this is where these categories have become tax efficient. But now also let's, add the investment advice to it. International funds, and not too many are open right now for investing. Gold, after a huge 40% run, is it still advisable? Would you look at these categories for investments this year?
So that's a tricky one, honestly. I think, look, as a diversification tool, both international and gold, I think always merits an allocation in any kind of portfolio. Whether that allocation is 10% to international and 10% to gold or 10% to international and 20% to gold, silver put together, I think that will completely depend on the nature of the investor, his appetite, risk appetite, and few other parameters. But my sense is, as a portfolio asset allocation, these are core parts and cannot be missed. One needs to have it. However, at this juncture, would I advise anyone to invest more in gold and go over allocate out there? Honestly, not. I think it's not the time to over allocate into commodities right now. Perhaps if you're sitting on some allocation, yes, make the most of it. But it's not the time to add further at these levels. And if you are any which ways over allocated as per your asset allocation, then you might just look at taking something off the table as well.
Okay, all right. So don't get carried away in the gold rush. That's the advice coming in from Mohit. Though there are people out there on the street, targets are ranging up to $4,000 in gold. But that's a debate for another time. Mohit, now back to this whole question of fixed income or hybrid funds or arbitrage funds. I'm going back to the point of asset class diversification. We can't have only equities in our portfolio. We've discussed gold, we've discussed foreign funds or global funds. How to take tax efficient fixed income sort of exposure in the portfolio?
So honestly, I think finding a tax efficient fixed income mutual fund option is like finding a needle in a haystack. But you have few needles out there if you are like really keen to find one. So I think there's this new category which is ushered in, which is called income plus arbitrage category. I think the category very smartly plays around 35 plus percent composition into arbitrage, and the remaining portion is treated is into fixed income investments, which could be short maturity fixed income papers or long maturity fixed income papers. All fund houses have their own modus operandi to deal with the fixed income paper. But that category effectively gives you a 2-year long-term capital gain taxation, which is 12.5%, and absolves you from the fixed income taxation, which is at your slab rate. So that's one category. The second category, which is not exactly fixed income by definition, but the return profile is fixed income and the safety profile is also closer to fixed income, is arbitrage category, which has been extremely popular of late, and that gives you a proper equity taxation, which is 1-year long-term capital gains at 12.5%. And the third category is equity savings category, which is a composition of arbitrage plus naked equity in the portfolio. Again, will give you a pure equity taxation in the portfolio. So yes, in pecking order, pure fixed income, then you go with income plus arbitrage category, and otherwise you have arbitrage and the equity savings categories.
Okay, great. So those are some examples of maybe some fixed income funds which are not entirely, taxing, so to speak, on our returns and our investments. But otherwise, Mayur, do you want to add to that on fixed income, or quasi-fixed income plays? Some people say REITs are like quasi-fixed income, steady income generating plays. So maybe not pure debt. I'm not saying FD or strict fixed income fund, but anything else, stable, safe, and where tax will not bite too much.
Yeah, so if you look at AIF investment in category 1, category 2 are completely tax free in that sense. So there is no tax incident on the earner, the investors. So if you are investing which has such kind of benefit, then definitely you can really look at, because that is purely tax efficient. The reason for that is tax is paid by the fund itself. So there is no tax which has to be paid by the investor then. If you look at category 3, it's a flow through. There also you will have advantage of whatever is being earned by the fund.
Yeah.
So there by default you get advantage because taxation is only at a one stage, then multiple stage.
But so you have to invest in big ticket sizes.
That's right.
Minimum threshold I think is 10 lakhs or higher, much higher for many of these funds, right?
That's right.
But that's where the tax advantages are. So for the HNI, ultra HNI or the affluent category, they could be considered.
Absolutely.
So we've covered a lot of asset classes. This has been a breathtaking rush. We've done equities, fixed income, we've done gold, real estate very, very carefully. Because even in real estate, Mayur, last couple of years, we've seen changes. I think even that reinvestment, if you're selling your house, I think you can now split it across 2 properties, house properties, if I'm remembering correctly. So just again, revisit for us, from a tax perspective, if I want to buy a house this year, is there anything new? I don't think there is. And if I want to sell a house or sell a house property, then how can I plan it effectively?
So when you are selling a house, if it's a long term, there are 2 things. One, with indexation, you want to consider in that situation, you will the tax will have to be paid at the rate of 20%. But because of indexation, if you are suffering any losses, that will not be allowed to be carried forward.
Okay.
And that will be foregone then. But if you are if you are getting tax at 12.5%, then there is no challenge.
Okay.
Now, how do you really save tax when you have sold one property? If the entire gain is reinvested.
And before we talk about that, I just want to, because there was a lot of debate when this was announced, whether you pick 12.5% without indexation or 20% with indexation. Again, what is the final thumb rule that the calculations showed up? When should you consider 20% with indexation and when is 12.5% better? Is there some math to it?
So it's still an iteration process as of today also, but there is some guidelines around it. And let me explain those guidelines. What happens is that if your gain is much bigger than the expected or inflation rates or in index number, in that situation, I think going for 12.5 without indexation is much better.
Okay.
But whereas if your a value increase is not much, then going with the old method is much better, where you will be not paying any taxes thereon, though the losses will not be allowed, but you will not be able, you don't have to pay any tax thereon.
Okay.
It is like when we are looking at new regime, old regime, the same rules will have to be applied here as well now.
Okay, got it, got it. So that's the rough rule of thumb. But you were saying that if someone wants to save on these capital gains, they can reinvest the gains as well, right?
Correct.
What are the options there?
So there are two options. One is that either you invest gain in another property, and here I am talking about gain and not sales proceeds. But you can invest up to 10 CR and you will get the benefit in that.
Okay.
So if you are investing more than 10 CR, then you will not get, proportionally those benefits will get diluted.
Sure.
Now when we are really looking at another thing is that you invest in infrastructure bonds. But the investment or gain in their sales proceed invested can be up to 50 lakhs.
Right.
And it does not offer larger advantage. Another disadvantage of that investment will get locked in for 5 years, whereas in property investment will get locked in for 3 years.
Okay.
So that is the that is how you have to analyze. But more often than not, infrastructure bond does not give you good yield, and I'm sure Mohit will be able to answer that.
Okay, Mohit, so last word with you then. Now we've understood the full tax math for this year, all the rates for this year. So any advice in terms of which asset classes look better, where to book some profit, where to keep, where to increase exposure in general, to wrap up?
Look, Surbhi, as long as real estate is considered, I'm a proponent of REITs and InvITs, and I think the taxation out there is also pretty favorable, which is 12.5% with a 24-month kind of an holding. So my sense is that's a 12-month kind of an holding at long term. So my sense is that's a great way to invest in real estate. But overall, I would still at the pecking order, in spite of the taxes going up from 10 to 12.5, I would still rate equity by far the most coveted asset class, and by far the one which should demand the highest proportionate allocation in any portfolio, followed of course by commodities and fixed income. Depends on the risk profile and the nature, and fixed income can be made tax efficient in a portfolio depending on the outlook of a portfolio, right? So there are multiple ways to do all this. So.
Fabulous, fabulous, gentlemen. I think this has been a very, very helpful refresher, a great crash course, stepping stone to how we can plan our investments and our sort of income streams better from a tax lens this year, FY26. Thank you so much for joining in. Great talking to both of you. Well, viewers, we hope you found this session useful. I certainly did. Keep sending us your feedback, queries, comments. See you next week with another theme.
Let's talk money.